I'm going to teach you how to make your first $10,000 selling options, even if you've never sold an option before. In this screenshot to the left of me, I made $90,000 day trading. Yeah, you can trade, you can gamble, you can make some money, but can you make it again and again and again? The answer is no. And I've been in this game long enough because I can tell you the people you look up to online that are making money day trading, they're not in this game in a year from now. The chance of them just disappearing is very high. If you want to be making money over years and years consistently, option selling is the route. I'm going to give you the 6 simple steps you can follow in this video from the beginning to the end of option selling to help you hit that goal. And more importantly, let's start outlining students and what the results could look like. And I'm trying to give you this to show you that beginners can just start selling options and hit some insane goals. Elizabeth is up 35% this year when the market's flat. The market hasn't made a new all-time high, but she's outperformed the market simply selling options. And we had one of the worst market dips ever where everybody got flushed out and she's still up. We had one student come in, complete beginner, started to sell options, paid for a trip to Hawaii. So they're already reaching their goals. Like, people set these goals with what they want to accomplish in the markets, and sometimes it can happen in a week or a month with the right strategy. I've been coaching Andy for years, and option selling might seem boring and it might seem like you can't make enough money, but I'm going to blow your mind what I've done with it. But Andy put on this trade for $170, just a small trade, exited it the same day, 3 hours later, from option selling, making $140. It can be sexy. It can be even tradable if you do it right. He's up even $5,000 today. This dude is on fire. But let's go over my journey. Who's Matt? Why is he yapping at you? What does he have to tell me? Why should I trust him? My first option selling paycheck was in 2018. I sold a Spotify CSP. I made $500 and I never looked back, because what happened before that is I took my 3K account to 50K day trading. I was stressed out all the time. I didn't know if I was going to have a $50 day or a 50K loss day. Who knows? But what I knew is that wasn't the route for me long term. It wasn't sustainable mentally, physically, and emotionally. And once I sold options, I was just blown away at how simple, easy, low risk, and low stress it was. Moving forward, last year, you might have seen the massive account push, and I can't buy options on this account, so it's strictly option selling. I was just selling puts and calls, and I told you guys on the YouTube channel about Tesla at the exact bottom, and this allowed me to, with multiple other trades I gave you, grow 150K to 500K, leading me to my best year ever of 350K in one single account. So that is from strictly option selling. My goal this year is to go above and beyond. I don't want to make $1 million. I want to make it passively. I'm trying to have a bot trade my system. That's how confident I am. I could program this bot and have it make me money in my sleep. In just 2 weeks option selling, I'm up 6% while the bot was launched. So that's my goal, just so you know my journey and my path right now. But let's go over the basics and unlock the first step of getting you to that 10K goal, which is understanding option selling in general. So option selling beats option buying every day of the week. The buyer is the gambler. They're lighting money on fire, and they're not here consistently making money in a year or two from now. The people trading the markets and having that as their only source of income will be greatly disappointed. These sellers are the casino. So you can be the casino. You can have a high win rate. You can generate passive income because there's so many gamblers out there. The gamblers, as you know, are buying options and they are losing money daily because the options are decaying every single day. So the buyer loses that money, but the other side of the trade, there's somebody else holding that contract. That's the seller. They're making that daily decay as a passive income paycheck. It's wild. And the buyer, what they're doing is They're really trying to get a significant move so they can make 100, 200, 500%. So they're betting. They're always betting. They're betting because they need the move. They need that big move, and they need it in a certain amount of time because the options are time-based contracts. So it's a very strong bet because you're betting on direction within a certain time frame. That's why they're always losing. The chance of profit with an option buyer is 20 to 30%. It's all or nothing, and that's not a sustainable way to make money. The option seller, 70 to 90% chance of profit because they're the opposite of the buyer. If the buyer's gambling and it's less than a coin flip, whether they make money or lose money, the option seller always knows over the long run they're going to be profitable and they can generate that income. And they don't have to look at the computers. They don't have to guess on technical analysis, have the very perfect entry every single day of the week. And here's really the reason the option contracts are so profitable for the seller, because people, when they buy options, they're not buying long-term options. No, those would be too boring, too safe. Those options barely lose value per day. But what happens is every single month that passes, the decay on the option gets more extreme. And if we look at it as the percentage of the option, you're losing almost 10% of the option's value weekly. And this decay basically drops to zero in the last 30 days. So you can see that the value of the option is slowly decaying in the first 3 to 6 months. But in the last 7 to 30 days, boom. I mean, those paychecks are within, like you saw Andy's trade, within hours. I mean, can you imagine thinking this is boring, but really, you could get paid just as quickly as a trader? So selling options, the basic math of it, I really want to explain this, is there's two scenarios that you get paid with. It's volatility and theta. Those are the Greeks, Vega and Theta. Volatility is how expensive the option is. It's based off of how much the stock typically moves. So if someone wanted to bet on, let's say, Coca-Cola is going to move 50 cents if it's lucky. If someone's going to bet on Tesla, Tesla's going to move $50. So the price of the option is really based off what could the movement be. And the beautiful thing about that is there's very expensive option chains out there, which is based off of Vega and volatility. And you're getting paid more as an option seller for those expensive option chains. There's a little bit more risk with selling those high IV options, but you get paid a lot more. There's options that could pay you 20% in a month. There's options that can pay you 1% in a month. And that's really dictated off volatility. The other thing that happens is this price of the option will decay every single day. So theta is that daily decay. The rate of theta is really based off how expensive the option is. For example, I love this trade. I love this option. This is what the bot is running. I'll talk about it more in this video, but TSLL, this is a put, a $14 put with 17 days till expiration, costing $148. So 1.48. If you can look at the stock price, if we were to stay within this line here of $14, this option is going to lose about $3 to $5 a day, $3 to $5, $3 to $5, $3 to $5. But as we get closer and closer to expiration, you're going to lose here. This one's $6, this one's $20, this one's $10, $10, $10, $10, $10. So you're increasing the rate of decay. But for example, if you had an option with low IV, you're not going to get too much decay. And that's where you're just going to have to figure out the difference of your risk tolerance. But I'm going to show you an example of Coca-Cola. Coca-Cola, let's say 17 days out, if we sell a put at the money, you have a $72 credit here. But every single day, if we look at the line, the white line here, you're going to make $2 a day, two. So yeah, the option decay is where your paycheck can get large or small based off volatility and theta. So I'm going to teach you ways to increase that with what the bot is running, what the bot's trading, but I just want to give you an overview of this. So there's two types of options we're going to teach today, basically selling puts and selling calls. So most people buy those. We want to teach you how to sell them. But when you sell these options, there is an agreement you make where you're going to have to buy the shares of XYZ stock. And if you sell a call, you're going to have to sell shares of XYZ stock. So you have to own the stock to sell calls. You have to own the cash to sell puts. And we'll talk about that math in a second. But basically, if the price of the option is 70 right here, and this is a great site, I love Option Strat, 70, we multiply that by 100, and that's the amount we have to have as collateral. Collateral is right here. Collateral is how much you need to reserve to own the shares if assignment happens. We'll talk about assignment in a second, but this is very important. You do need to have this reserved so that you can buy these shares at that price, at the specified strike price here. If there are cheaper option chains out there, we're going to teach you how to use TSLL, and this one only requires $1,400 of collateral. It's a beautiful thing. And you can even use more expensive, even cheaper ones. I know option chains that are $500 or $100, but they get riskier as they get lower. So the terminology, just so we run through it and you understand it, a put, when you sell a put, it's basically the right to own the shares at the specified strike. If you buy the put, you're doing the opposite of that. So put buyers are trying to sell shares if they get assigned or exercised, and put sellers are trying to get the shares. So calls are where you lose the stock as the seller, you buy the stock if you're buying the call. Most people don't need to know that or do that, but this is where it gets more important in terms of everything in the option chain related to the option seller. The premium is when you sell the option, it's the cost of the option in a credit form. So if I click this $14 put, you can see the bid is $146 and the ask is $154. That is the premium. Basically, when you get into the trade as the option seller, this 146 to 154 range is the premium. You are trying to collect as much of that as possible through decay. You won't collect it all. You'll maybe collect half. You'll maybe collect 70% of that premium, which means half of 146 is $70 because we multiply this by 100, which is like that 150 credit you see here. 150 divided by 2, half, you're typically collecting half of the credit. So you're not always collecting the full thing. So when you're selling an option, the premium or the credit is what you're trying to collect, but you don't collect it all. That's a big difference of how I run the wheel. And we'll talk about the wheel in a second. But the strike price is varied based off of all these numbers on the option chain. So some strike prices you have less credit, some strike prices you have more credit. So it's just based off of typically where you want to own the stock. Let's say you wanted to sell a put and you wanted to own the stock at $10. Cool. But you have a lot smaller credit because you're much further away from 10. If the stock's trading at 13, the further away you go, the less credit you would have as an option seller. So collecting $20 is cool, but wouldn't it be cool collecting 75? Wouldn't it be cool collecting 148? You typically don't go over the price of the stock that's selling options we call in the money. We'll talk about that in a second, but you're typically going to sell an option at the price and below. And the further away you are, the less you collect, but the safer you're going to be because you're going to typically pick up the stock at the greatest discount if it were to fall. The other thing that's related to the option chain is the expiration date. This is the time where the option's going to end trading, and at that time, either you collect all your money if you were to keep holding it. For example, if you sold this 10 put 17 days out, on the last day, on the 11th of July, if you held it, you would collect the full $18. But if the stock dropped to 10, let's say the stock dropped to 10 or under, you would own the shares and collect the premium. So assignment is a really interesting thing because that's when you're going to pick up stock, lose stock, or collect full premium. You're always collecting full premium, but there's that factor of gaining or losing stock. So the basic tools to get started, we'll go over more details of option selling, but just to get you ready for what you need, I would suggest 10K of collateral just to sell puts. Some options you could probably only sell even one with that collateral. Some you could sell 2 to 3, but 10,000 is a good starting spot. And then a rules-based mindset. We're going to show you a system today, one that's not based on emotions, one that you could reliably get some type of income after watching this video week after week. And then the best brokerages you could use are Thinkorswim, Tastyworks, Robinhood, Webull. I'm going to show you Robinhood as an example today of how to sell options, but there's some other scenarios if you want. So number 2 is the first steps. Entering the trade, knowing the basics of it, all that stuff. We're going to go over that cash secured put. Basically, you're selling the put. Like I said earlier, you need the cash ready to buy the shares. So for TSLL, we're going to be using this today as our star student, our star trade to have you start learning and using. The collateral is based off the strike price. As you can see, the price could be $1,000 for collateral all the way up to $1,200, all the way up to $1,400. So that strike price could differ greatly, and it could be how much collateral you need reserved, which is cash on the side. Don't sell puts on margin. It's super dangerous. Some brokerages allow you to collect the premium up front. Most of the time, you need the premium to decay or lose value for you to make money. For example, inside the coaching program, we have a CSP on Amazon, the 2X Amazon fund, Amazon U, that is decayed 36%. When we got in this trade, we got in at 180 and it's currently trading at 120. Most brokerages will only give you money if that decay happened, where today it's trading at a lower value, so you theoretically have that ability to lock in the profit, have that money in your account as profit once it's locked in. So that's $65. If I close this trade today with the students, boom, we locked it in, we have that $65, we're out. But some brokerages, they will give you the premium up front. I'd say that's a big red flag because you're going to trade on margin, so be very careful. The only thing you're doing as an option seller is when you're making that trade, and you're having that cash available, you're agreeing to buy the stock at a discount, hopefully. So assignment, we'll talk about that in a second, is where you are forced to own the shares if you held the option through expiration. You have to hold the option through expiration to get assigned. Very rarely would you get assigned before. You don't have the control as the option seller. So there is a chance you wake up. You have to own the shares before expiration. Most of the time, that's when you're deep in the money. And then the safe reason is, the reason why we're doing this is because we want to teach you how to do it with quality names, not do it with leverage. We're not trying to use any margin. So you're not selling puts without that collateral. That collateral is the protection to make sure you're not losing your whole account in a day. When you sell options, it's extremely safe because the stocks aren't going to zero. Stocks are going to be here in 5 to 10 years, especially quality names. So if we just sell options, we're likely to preserve our capital better. All right. And then I don't think I have the... Okay, and then we'll go over the wheel, and then I want to go over strike prices, assignment, out of the money, in the money, all that stuff. But the wheel is what we're teaching you to use, which is where you're selling a put option. And when you sell puts, there's two scenarios. You collect the premium or you get the shares at expiration. Again, you're always collecting the premium, but this second part sometimes happens, sometimes doesn't. If you do end up owning shares, you lose your cash to buy the shares. And what happens is you can still make passive income with the shares, which is the really exciting thing. This is where we're writing covered calls with those shares. And then when you write covered calls, you're putting on this short call that allows you to lose the shares if it hits the short call. We'll go over that in a second. But basically, if we complete this whole option selling, we're always making passive income every single day of the week. There's just some times where we have cash and sometimes where we own stock, but we still have the ability to make passive income regardless. So let's talk about assignment, talk about in the money, out of the money, at the money, all that stuff. So assignment with a put is where you own shares. The only reason you would get assigned for the most part is this expiration date hits June 27th. You hold your put through expiration and you're underneath the orange line here. So if you were selling a put at 13, this is where, selling a put. Let's go back. All right, I had it backwards. So sell put, and I'll show you how to put on this trade in a second, but now it's the green line. Above the green line is where you would have to pick up these shares. So if you went to expiration in 3 days and you were selling this $14 put and the price was underneath, so $13.80, we're at $13.80, you have to own TSLL at 14. So anything above the line, you have to pick up the shares at expiration. Anything below the line, you just hold your put through expiration. You have the put disappear on Monday and you can sell another put with your cash Monday at the open. So you can just keep selling puts as long as you're underneath the stock price. The minute the stock price goes under your strike price is here, that's when you have to be an owner of the stock at this certain price. So the wheel is an sometimes intentional way to own stock, but you're always doing it at a discount. Because if you look at the wheel with the expiration date 17 days out, anything at the current price here and under, you can see the break even over here on the right. This is a 10% discount. And if we sell, let's say 3 strikes down, it's a 15% discount. And if we sell another 3 strikes down, it's a 20% discount. So you can strategically say, I want to own the shares at a X% discount. And so your goal is to actually be an owner at some point. You don't want to always fear ownership. But the beauty is, if the market were to fall apart, there's this buffer before you lose money. And it's typically that buffer I just showed you here on the right. So if your strike price is 14, what we typically do is subtract the credit. So if you had to own the shares at 14, you're going to get this credit. So that's going to lower your cost basis. So that's included when you own the shares. And when selling a covered call, that's the other side of the wheel. That's when we, instead of doing puts, we're going to flip to calls here. So sell calls. And you could do anything typically above the price of the stock. And this is, again, all passive income here. And what this is allowing you to do is say, hey, I want to sell my shares at X price. And it gets a little tricky knowing which price to do, but we'll break that down. But if you rinse and repeat this is probably the most passive way to consistently make money because you can always be selling options. So here's a full example of the wheel. If you were selling a put at, let's say, $10 and the stock was trading at 12, you have a premium that's, say, 50 cents. that would be included in your cost of this stock when you get assigned. So if the price of the stock went from $12 to $9, you would have to get assigned. And that's where you own the shares. It would take $1,000 of your collateral. It would pick up the shares at 10, but it would also include that $50 of premium into your cost basis. So you don't own shares at 10, you own them at $9.50. And what happens is you have a $50 loss possibly. Who knows? Maybe the stock's at, let's say, $8.50. Like, you could be at a loss at the time of ownership. But what you could do is you could sell a call, let's say at $11, and you could collect this premium. So you're lowering your cost basis one more time from $9.50 to $9.10 doing a call. And what happens is, let's say the stock, when it dropped and you got assigned, was at $8, and then within selling a covered call, it went up to 11 or 12 or 13 or 14. If it passes that covered call strike, you lose your shares. So what happens is that $50 of initial premium here, plus the $40 of initial premium here, and then sometimes there's this appreciation factor. So let's say you got in at 10 for your first strike price and you sold your other strike price at 11. There's a $1 difference there. So you can actually make money from the stock, this is $100 appreciation. You can make money in 3 ways doing this wheel: CSP premium, covered call premium, and then share appreciation. This is why the wheel is so powerful, because there's more than just premiums to collect. You can collect money from appreciation. So the best stocks to be selling options on are liquid. They have good bid-ask spreads, good volume. Like, I love TSLL because look at the volume today: 186 contracts, 700 open interest. The bid-ask is very tight. It's between 140 and 149. That's a $9 wide bid-ask, which is within, I think, like 5% of the price. Sometimes, like Amazon U, which we put on with the students, won't have as good bid-ask. Like, this is, that's pretty good there. This one looks like it's slipping a little bit more. This starts at 100. This starts at 120. That's almost a 20% bid ask. You could see 13%. And the volume's 1 and the open interest is 4. So the wider it is, the more you're going to lose money getting in and out. Trading that, it's going to be a nightmare. So affordable shares, if you have a small account, be aware you have to stick to a price range. So choose quality names with a good price range depending on your budget and everything. And then lastly, companies that are going to be here in 5 to 10 years are a great way to approach option selling. You want to be in quality companies that can survive. And I look for stocks that can get an IV over 50%. That's a personal preference that allows me to maximize my income as an option seller. If we have IV over 50, you're going to make probably 3 to 5% a month. If you have IV in the 70s and 90s, you might make 5 to 10% a month. So if it can be a quality name with high IV, that's like Tesla, you can make great money. So my option bot is currently trading TSLL. And the reason why I chose this is because it's a 2x leverage version of Tesla. I love Tesla. I believe in Tesla. I think it's going to be here in 5-10 years, especially a lot higher. But the crazy thing is that you can use these leveraged ETFs and you can basically double your premium. For example, TSLA, the IV is 63%. So if I were to put $30,000 and sell options 17 days out, I could make a 5% return. 5% return in 2 weeks. But if I use TSLL and I use $30,000, which is a lot more contracts, by the way, you're going to see the return is double. So instead of making $1,700 in 2 weeks, I can make $3,300. So I don't mind taking that leveraged ETF risk because I vet the company. I like the company. I don't mind that risk because I have such a strong belief in that company long term. So that leverage component should serve me well collecting premiums. So be very careful option selling. There are some major risks I want to go over. There are option chains that are very high IV, but because they're very risky and they produce a lot of downside for the most part. So stocks that have had the highest IV in history tend to fall the most over the next 5 years. I'm going to show you an example of a stock that everybody was obsessed with during COVID, Lucid. Lucid was a car company. It still is, I guess. But this stock went up to $60, $58, and the option chain was giving you 10, 20% a month selling puts. But this was a huge trap because long term didn't have any fundamentals to stand on. Wasn't going to be a company that was going to help investors at all. So it deteriorated. And a lot of people got stuck because they chased the premiums on stocks that didn't really deserve to be in their portfolios because they weren't quality companies. Liquid options, avoid those. Like I said, you're going to pay a lot. Getting in and out just wastes money. And then low premium, we're not trying to do the wheel on Coca-Cola. Like, if you're going to try what I'm telling you, it makes more sense to get that IV to 50%. If it's too low, you might as well just buy options, like buy leap options and hold, because those are so cheap. The cheapest options, you want to be a buyer. Avoid option selling around earnings. Obviously, big announcements, FOMC, you might get blasted. You might get a cheaper entry. So you might want to wait a couple days around that stuff. So how to find a good put to sell? I like to go 15 to 30 DTEs, and I like to shoot for 10% a month. So I want to show you how to find your perfect put, how to put it in your brokerage. So your first trade, let's break it down for a CSP. This is a live put walkthrough. If I were to sell a put and I had $10,000, here's what I would do. I would go, like I said, 15, 30 days out, and I like to sell 2 strikes to 3 strikes down because I like to get assigned. So right now, that's my risk tolerance. Some markets I might want to sell less aggressive, but right now, I'm trying to get this stock, which is TSLL. This is what the option bot is selling on a weekly basis. But we can see that right here, I would sell 3 strikes down, and I want to click sell put. In some brokerages like Schwab or Fidelity, it's a negative contract when you sell. So the contracts are negative. On Robinhood, they're not. It just says positive, but it does say short put up here, which assumes it's negative. So if let's say I do 8 contracts here at $75 or $74, this is a $500 and $591 paycheck in 2 weeks. And the collateral needed looks like $10,000. I want to get to, what did I say, 10,000? Yeah, so 10,000 on the nose, 10,000 on the nose. So I'm able to generate $600 off 10K in 2 weeks. And if you got, obviously, bigger account, you got $100,000, we're talking $6,000 in 2 weeks. Like I said, we're going to get you that $10,000 mark in a month. So if you have more money, this gets really, really, really fun, and it's very, very, very passive. So that's how I put in this trade. You want to put your order in between the bid and the ask here. So we're between 63 and 80. You want to go as high as possible. High is the more premium to be collected. If we go too low, we're just giving up easy money we can be making. So if I go in, I'm going to try to go in at maybe 72, which is the middle. I want to go in the middle. And if I don't get filled, I lower it. If I don't get filled in 5 minutes, I lower it again. So I love, at this point, this option chain and this stock. This is probably one of my favorite ones we've done in the coaching program and the one I'm doing with my bot. Once you're in the trade, you want to exit the trade, buy to close. Because we sold the put to get in, we want to buy the put to get out. And if we buy it at 50% of the premium, that's my goal most of the time. I never want to collect the full thing. So if I'm collecting off of 8 contracts, $600, I'm probably going to get half of that as quickly as possible and exit. For the most part, you might hold through the full duration and you might get the full 600, but your money's best spent repeating this again and again. So I like to sell puts when I collect half and then put my money back in when the market drops. For example, Tesla's down today. I sold puts, got out yesterday at a profit, and I got back in today when the market dips. So if you can re-enter on dips, that's a major bonus. So don't wait for 100%. Don't try to hold till expiration. You might be able to put on 3 trades by the time this one trade expired, which means you could probably triple your income. So that's kind of my strategy. And then rolling is where you're exiting your current trade, opening a new trade. Some platforms, they do it in one single trade. Some platforms, you have to do it separately. I think Robinhood could do one single trade as a roll. And that's something you could watch a tutorial online and get that pretty easily. But you're typically opening a new position at a later date when you roll an option. And this allows you to make more money. For example, if you add 2 more weeks to this option, you're not collecting $600. You'd be collecting, let's check the option now. The 1250 put, if I go there and I put in 8, you're collecting $1,000 versus 600. So more time equals more premium equals more money. Beautiful. So if the stock drops, you're probably worried, you're probably wondering, let me tell you what happens. This is not a bug. This is exactly what's meant to happen. The stocks go up in life, the stocks go down. Your goal is to own the stock. You want to own the stock. You make more money owning the stock. If I showed you the profit again of that breakdown of the full wheel, you're going to see something wild. You're going to see that when the stock actually dropped here and you got assigned and you wrote covered calls, what happened was you made triple your income because you made the income from the covered call and from the appreciation. The appreciation is typically your biggest paycheck you're ever going to get. And you can't get that paycheck until you get assigned. So most people are worried about getting assigned and making this perfect and like having the market keep dropping and oh no, I got to keep holding. But that's not a big deal. You just keep writing covered calls. You keep selling more puts if you can. So as long as you can be comfortable with this, you're going to make a lot more money. So once we get assigned, we're just going to try to lower our cost basis by doing the wheel with covered calls. And if you did this weekly with TSLL or even bi-weekly, you're lowering your cost basis by a full $1. So let's go back to that one contract. One contract costs like $140. If we go to calls here, slightly out of the money, it's $100 a contract. That means every 2 weeks you're lowering your entry price in this by $1. So this is a $15 stock, which means if you wrote 15 covered calls, it's a free investment. So it's not a bad thing to write covered calls and have to do the other side of the wheel. It gets exciting. But let's talk about the details of getting the stock and what this looks like. Basically, when you sell a put, plan for ownership. Look at that strike you're selling the put at and say, hey, I want to own the shares at this price. I'm actually excited to do it. And you have to obviously have the cash ready and expect the stock to be underneath that strike price. Expect to see a loss and expect to kind of have to wait a little bit till you start doing covered call. You could put them on right away. You could wait. But if you want to maximize your money, I'm going to give you the formula for that. So for the covered call, I'm going to show you the right times to put it on. But selling calls is where it's exciting. That's where you're going to make the most money. So once we own the shares through assignment, or if we just picked up the stock just organically, just buying it, we're going to sell this specific strike price. The same way we sold the put I showed you, we're going to sell the call 2-3 strikes down, or 2-3 strikes up. So plus 2-3 strikes. So what happens is the price of the stock is about 14 for TSLL. I'm going to sell a covered call 2-3 strikes up. So 15.50. This allows me to make money to the upside. You can see I have a $85 credit, which is like a 5% return. But I also have a appreciation, which is a 10% return. So if I total the two returns up, I have an 18% upside here. That's beautiful. So I want to choose that expiration 30 days out, like I said, and you're going to sell the contract to open. I'll show you a live example in a second. But my bread and butter for the wheel is I sell puts on down days. I sell calls on up days. And if you can wait for the stock to hit a 5 or 10% up day, you're going to maximize the wheel like a champ and have that income. Lastly, if we can cover just a little bit, let's say half of the position, you're going to also maximize the income more. For example, if the market were to move 5 or 10%, you did half of your position covered calls. We did another 5 or 10%. You did the other half. You're going to make way more. You might make a 30% return. You're going to have your best months in the market when you become an owner and get the upside. So when you do the covered call, let me show you the breakdown here. But first, let me run down the cost basis analysis. So should you sell covered calls if you're eating a big loss, if you're selling underneath your ownership level? And yes, that's my answer, yes. As long as you have a good up day, as long as the market moves higher, yes, selling covered calls on updates, even under your ownership level, is fine. Because what happens is you're going to lower that cost basis. So if you have a stock at $12 and you sell a covered call at $11, you're saying to the market, I want to limit my upside at $11. I'm going to lose the shares at $11 and I'm fine with it. And if I own the stocks at $12, I'm eating $1 loss a share and I'm locking in that opportunity for the expiration. So there is a chance you're going to lose the stock at a loss. There's a but though. You lowered your cost basis by selling a call, and you, more importantly, the market might keep dropping and you might have a bigger loss. So if you didn't sell the call, you would have a bigger loss to begin with. So by selling calls, you're always lowering the cost basis, lowering the risk, and also increasing your cash because that becomes cash eventually. So if the market were to drop, let's say 8 weeks in a row, you might be able to sell covered calls and generate great income. But if you're too afraid to sell underneath your ownership level, you'd miss out on 8 weeks of money. And the thing is, you don't have to sell everything. You could just sell half. Selling partially is a major unlock, especially in a downturn, just to generate some income, lower the cost basis. Because like I said, you might get this stock for free if you sell enough options. So here's an example of the TSLL. If I were to do the perfect covered call, I'm going 3 strikes out of the money. And if I own the stock at $12, I would collect this $96. And my cost basis goes down from 12 to 11.04. If you do this enough, again, you could have free shares in some time of the market. But you are saying, I want to lose the shares at 15. But again, you add that credit to it. So you're really losing the shares at 15.96. So it's a beautiful thing to get both. So the complete wheel, just an overview. We sell CSPs. We're collecting premiums. We're agreeing to buy the stock at the strike price. We hit underneath the strike price. Like the market dips, the price of the stock goes under the strike. And that's where you own the shares. So you get assigned. You usually get a discount from the current price, which is not a good deal, which is not a bad deal. And then you just sell calls. Sell calls generate income. The stock rises, you lose the shares, you go to cash, and you start it again. It's called the wheel because you're always making income. And the reason why I like Tesla is because it's a banger. Jason just sent me a message today having $100,000 a year on just one ticker. And with all his tickers, he's having his best year ever. So you can make $10,000. I know you can. Jason hit $100,000 with just TSLL. It's an absolute premium machine. So if you got $100 in your account, this is not enough to start. If you got $2,000, you might be able to squeeze a couple tickers and generate $100 a month. If you have $20,000, we're looking at $1,000 in a month. And once you hit 200K, that's where we can realistically see over and over again that 10K paycheck. So the tools you would want to set up if you want to start doing this, if you want to enhance your option selling, you do need your brokerage platform. You do need a scanner to find the stocks, and if you don't want to use TSLL. So high IV stocks that are also safe. And I like to use the leveraged ETFs. But again, be careful chasing premiums on not companies that are going to be here in 5-10 years, or companies that just don't have a great revenue base. They don't have margins. They're not profitable. Think about just quality companies that are volatile. Like right now, HIMS is big in the news. HIMS is all over. HIMS is very profitable, huge growth rate, but the IV is massive. So a lot of risk, but it's also a great company. So if this is a company that's going to be around in 10 years, with a 90% IV, there's so much premium to collect. So off of a 30-day option, we're looking at a 10% return. So the option scanner will be able to find that if you go off IV, and then track your trades, monitor your results, make sure you're tweaking your system, going in on down days for selling puts, going in on up days for covered calls, and being an owner, owning the stock, riding it up as much as you can during a great market. And if you can download Tradingview, getting your technical analysis dialed in, understanding RSI, key levels, MACD, stochastics, just trying to sell options better with some good technicals is the next level. And the mental game, make sure you accomplish and master this. It's so important. It's not going to be sexy every single day. You might put on 2 trades a week, 3 trades a month, but it's enough to hit your goal. And if you want to scale your account and hit a $100,000 account from 10 or $1 million account from 100K, you got to start out at least snowballing something, getting that first win to the next one. So we think probabilities, we're not with emotions. We're trying to just sell puts on quality names, following the system. So trust the system. Hundreds and hundreds and hundreds of traders have come through our program and hit some insane goals just doing this. And we're on at this point, a 20 trade win streak. And last year we had a 6-month win streak of no losing CSPs. So it's not hard to just have months or even a year where you don't have a losing trade. And if you trust the system, it gets exciting. So most important thing, fill out coaching application. The link is in the description. We'll see if we can help you out. If you want to hit 5 or 10%, if you want the tools, if you want the live streams, if you want to just be more consistent and confident, be sure to get a coach in your corner. Don't try to piecemeal this together just from all these random YouTube videos, from all these random teachers. It's such a longer route to success. I'll see you guys in the next one. Peace out. Hope you have a good week in the markets.